Most stock traders lose because they think trading is about buying low and selling high. Newsflash, it's not. Trading is about understanding how the market really works, the psychology, the liquidity, and the structure behind every single move. And that's exactly what I'm gonna break down for you in this video. Everything from how the market actually functions to how professional stock traders think and execute. Now, bear in mind that this isn't some get-rich-quick video. This is a complete step-by-step guide that will show you exactly how to trade stocks the right way, with discipline, clarity, and structure. And if you stay till the end, I will show you how to get my full 10-hour trading course completely free. No fluff, no BS, no buy my course for $997 price tag, no email opt-ins, no upsells, just pure real education. Now, before you go any further, you might be wondering, why should you listen to this handsome Asian guy who's always wearing a hoodie? Well, I've been trading for nearly 7 years, and this year alone, I've made over $1 million in trading profits. Every single trade documented live on my second channel, Brad Trades. More importantly, I've helped hundreds of my students go from inconsistent to six-figure traders in less than a year. So I can guarantee you that everything I teach here comes from real experience, real trades, real data, and real results. So, I don't want your money, I want you to become a better trader. Now, like I said, what you will learn in this video isn't theory, it's what I actually do every single day in the market. Now, talk is cheap, so instead of just telling you, let me just show you. Here's my returns from one of my accounts. So I started this account earlier this year, and as you can see, so far we are already up about $111,000. And the goal now is to scale this account to $10 million. Now I'm showing you this not because I want to flex my profits. It's to prove to you that consistent, disciplined trading works. It's simply the result of following a mechanical system, managing risks, and just compounding my profits intelligently. Not gambling, not guessing, not trading with emotions, alright? And that's exactly what I'm going to be walking you through in this entire video. So now that you have seen what's actually possible when you trade with structure, let's break it down from the very beginning. What is trading? A lot of people mix up trading with investing, but they are completely different games. It's like comparing soccer to basketball or apples to oranges. Trading is basically short-term speculation for profit, which means that you're not trying to own a company. You're simply trying to take advantage of a price movement, right? That means you buy here, you get out here in the next one day, in the next few weeks, in the next minute or so, right? So it's just like you trying to capitalize on these short-term price movements. On the other hand, you got investing. Investing is long-term ownership of companies, which means you believe in this company, you think that it's gonna 10x in the next 10 years, you hold it through the ups and downs, the rainy and the sunny days, and you profit from growth over time. It could be 5 years, it could be 10 years. So the difference is pretty much the time horizon. Now, we traders profit from the day-to-day volatility of the market, not from dividends, not from capital appreciation, from holding the stocks. Now, the key difference is this. Investing is about time in the market. Trading is about timing the market. And once you understand that, everything about how you approach the charts, risk management, and mindset will change. Now, while this video is focused on trading stocks, remember, the timeless principles that I'm teaching you here today apply to investing as well. Like I said, the only difference between a trader and an investor is the time horizon in which they are in the market. The same psychology, the same technical analysis, the same structure, the same risk management framework apply, just stretch over different time frames. So now that you understand what trading really is, let's talk about how the stock market actually works behind the scenes. When you buy or sell a stock, you're not buying it from the company itself. You're actually buying it from another trader through an exchange like the New York Stock Exchange or Nasdaq, and your broker simply acts as the middleman, routing your order to the market, connecting you with someone else who's willing to take the opposite side. Which means that every single trade happens because someone out there in the world is disagreeing with you. You want to buy, they want to sell. You want to sell, they want to buy. Which is why if you are buying, it's because someone else out there believes that same stock is about to go down, and that's why they're selling it to you. And that's what makes the market move. Disagreement, which becomes liquidity. And here's the part that most retail traders tend to overlook. Institutions and algorithms and bots, professional traders, Wall Street traders, they make up over 70% of the daily trading volume. And this means that you are pretty much playing a game that is very, very difficult to win, right? Because you're not really competing against other beginners, others Tom, Dick, Harry. You are actually competing against professionals, hedge funds, and bots that operate 24/7, that is on their desk every single day, chipping away at economic reports just so that they can take your money. Which is why your edge will not come from analysis. It has to come from structural discipline and understanding market behavior, rather than trying to predict where price is going to go next. So here's a simple way to visualize how the stock market actually works. From the moment a company creates shares, all the way to you placing a trade. So we start with the primary market, which is also known as the IPO stage. This is where a company issues new shares for the first time so that they can raise capital. And this is a market which you and I probably don't have access to, right? It's only limited to a select group of investors. So these investors, they are buying the shares directly from the company, not from other traders. So once those shares are out in circulation, they move into the secondary market, which is what we use every single day as traders. This is the exchange, right? This is the New York Stock Exchange or the Nasdaq, where buyers or sellers are trading those shares back and forth. You know, people are buying, people are selling, which is why when you are buying a stock like, say, Apple, Tesla, Nvidia, or Microsoft, you're not actually buying from the company itself. You're just buying from another trader who's selling those shares. Next, we have the broker layer, which is your access point to the market. Now, your broker doesn't hold your trades. They simply route your orders to the exchange and they just match you with another trader or a liquidity provider. And that's exactly why execution, quality, and spreads matter so much. And finally, once your order goes through the system, the trade executed stage is where your order gets filled at market price. You now officially own those shares. Or if you're selling, your position is closed. So in short, company issue shares, they get listed on the stock exchange, brokers connect traders, and every single trade happens through this entire system. The market might look chaotic from the outside, but underneath is just a structured flow of orders and liquidity. Now let's talk about when the market actually moves. A lot of people know about the regular trading session, which is from 9:30 a.m. to 4 p.m. Eastern Time. But in reality, there are two other sessions that bookend that, which is the pre-market session and also the after-hours trading. And by the way, all the timing that you can see on the screen is based on Eastern Standard Time. So the pre-market session runs from around 4 a.m. to 9:30 a.m. This is where institutions, hedge funds, and professional traders, they want to position themselves before the market actually opens. And this is also when news catalysts like earnings release or economic data can trigger big move before most retail traders are even awake. And then after the regular session closes at around 4 p.m., we transition into the after hours market, which runs from 4 p.m. to about 8 p.m. This is when late breaking news can cause sharp reactions and when companies often release their earnings reports, which is also a time that a lot of traders tend to look out for. Now, while the pre-market session or the after hours sound exciting to trade, it's also the most risky period because during these sessions, liquidity is extremely thin, which means there is fewer buyers and sellers, which also means there is wider spreads, which also means that there is more commission costs, more slippage, and it's prone to sudden price spikes like unpredictable, volatile, whipsaw move, even if you are trading on small orders. So here's my advice. If you're completely new to trading, it's much more better to just observe these sessions at first before you start trading them. You're much better off just sticking to the regular hours, which is 9:30 a.m. to 4 p.m. until you can read volume and volatility properly. Now, as you gain more experience in the market, pre-market and after hours can actually be quite useful for you to catch early momentum or react to overnight news. But only if you manage risk tightly. So how do you actually enter into a trade? Because the type of order that you choose can completely change your results. Well, there are a few order types. The first one is the market order. This one executes instantly at the best available price. It's fast, but it gives you the least control because you are literally getting in at whatever price the market is offering you right now. And in high volatility or low liquidity conditions, you can potentially get filled at a worse price than you can expect. And that is why I only use market orders when I'm trading highly liquid names like Apple, Nvidia, or Tesla. And when I need immediate execution, like I need to get in right now, if not I'm gonna miss the move. That is when I use market order. Next is the limit order. This is the opposite. Basically, you are setting a price you want to buy or sell at, and the order only execute if the market reaches that price. And this type of order gives you control. But sometimes it won't get filled at all if price just misses that level. And then we have the stop orders. They are used for protection. They trigger a market order once price hits your stop level. So if you're in a long position and price drops below your risk level, your stop order exits you automatically to prevent bigger losses. So the rule of thumb is this. Use market orders for liquidity and speed. Use limit orders for precision. And use stop orders for protection. And during pre-market or after hours where the liquidity is a little bit thinner, just avoid market orders altogether, right? You're much better off sticking to limit orders so you don't get filled at crazy prices. Now, when you are choosing to execute a limit or stop order on your broker, it will ask you to fill in this thing called time in force. It simply tells your broker how long your order should stay active before it expires or cancel. And the most common one is the day order. This means that your order stays active for that trading session. And if it doesn't get filled by the market close, it's automatically cancelled. And this is the one that most traders use by default, all right, especially if they are trading intraday or they are scalping. Next, we have the good deal cancel. This one stays active until it's either filled or you manually cancel it, even if it takes several days. And a lot of swing traders actually use this type of order because they want to enter a position at a specific level, but they also don't want to watch the charts all day long. And then there's immediate or cancel. This order tries to fill instantly, and any portion that can't be filled is cancelled right away. And it's often used by scalpers or institutional traders when they want fast execution without leftover partials. And finally, we got a fill or kill. This one is all or nothing. If the entire order can't be filled immediately, it's cancelled. And this one is less common for retail traders, but it's actually kind of useful in fast moving markets or when you are using a large position size. So to simplify, day order, best for intraday setups. Good to cancel order, best for swing trades. IOC and FOK is used for scalping, used for speed and control during volatile movement. And you want to make sure that you choose the correct time in force based on your trading style. Now, if you're trading during the pre-market or after hours, be extra careful because some brokers, they don't actually support all the time in force types in those sessions. So always double check your platform settings. Now that you understand how orders work, the next question becomes which ones should you actually use? Well, like I said, it depends entirely on your trading style. If you're scalping, that means you are getting in and out fast, right? You're taking quick trades that last from a few seconds to a few minutes. You're most likely going to be relying on market or immediate or cancel orders. And then if you are day trading, that means you are getting in and out of the position within the same day itself, right? Ideally before the market closes. Then you will use a mix of market and limit orders. Usually with day order as your time in force, since you're closing everything before the market actually ends. And then if you want to be a swing trader, which means you're holding the trade for days or even for a few weeks, then you will often use limit or good deal cancel orders so that your entries stay active overnight. And then lastly, if you are position trading, which means you are holding the trade much longer for a few months or even a few years, you'll rely on limit orders or good deal cancel orders so that you can really manage your risk over time. Basically, you want to choose the trading style that fits your time, your schedule, your personality, and your patience level. For me personally, I'm more of like a mix between a day trader and a swing trader. But for you, you could be a scalper, right? Because you might enjoy the adrenaline. Or you could be a position trader because you just want to be more calm and relaxed and trade over the long term, right? So choose that one trading style that suits you the best. And the key here is this. Your order type and your time in force setting must match your time horizon and your strategy. A lot of beginners lose because they try to mix short-term tactics with long-term setups. They are trying to impose short-term strategies with their long time horizon, right? Which doesn't make sense. Now let's talk about how traders actually analyze the market. Everything you will ever learn in trading falls under two main pillars: fundamental analysis and technical analysis. Fundamental analysis looks at the company itself. Things like the earning reports, the PE ratio, the price to earning ratio, the revenue growth, the balance sheet, the financial statements, and overall economic conditions. Quite simply put, it's about understanding the business behind the stock. And this is what a lot of long-term investors focus on. You know, they like Warren Buffett sort of stuff. They want to focus on companies that have good PE ratio, blue chip stocks, companies like Apple or Microsoft with like a strong balance sheet and consistent revenue growth and a good management. This is more for like investors. Technical analysis, on the other hand, focuses purely on price, trends, volume, patterns, and the market sentiment. So instead of asking, is this company good? Technical traders, they're asking, what is the market trying to tell me right now? And most professional traders, they actually use a mix of both. As the saying goes, fundamentals tells you what to buy. Technicals tell you when to buy. But for short-term trading, which is what we're going to be focusing on today in this video, technical analysis dominates because price moves long before fundamentals actually catch up. And we are not really trying to predict the company's future earnings. We are trying to understand the flow of money and the psychology happening on the chart right now, aka the market behavior. Now, if you want to learn more about the differences between fundamental analysis and technical analysis, you can pause this video right now and go through everything here in this table. Now, even though I focus mostly on technical analysis, fundamentals still matter to me, especially for timing and volatility. Let me explain. Every single quarter, companies release earning reports and forecasts. And when they do that, they create massive spikes in volatility, especially in large cap stocks like Apple, Nvidia, Tesla, or Microsoft. This is where a lot of traders, they're going to be anticipating on whether the earnings is going to be the expectation, and then they're going to be trying to buy or they're going to try to sell. And this is where the saying, buy the rumor, sell the news, actually come into play. So even if you trade purely off the charts, you still have to know when these events happen, because earning reports, right, all of this forecasting can completely distort the price structure and volume. Next, we have sector rotation. Money in the stock market moves in cycles, from technology to energy to financials, depending on where the economy is right now and where interest rates are headed next. So if you're trading individual stocks, you will notice they tend to move with their sector. For example, Apple is a tech stock, and when the entire technology index goes up, right, Nasdaq goes up, you will see Apple also start going up as well, right, because it belongs to that sector. And understanding these broader trends and market cycles help you stay aligned with where institutional money is flowing next. And finally, remember that market sentiment often overrides logic in the short term, which means that a company can beat earnings and still drop. It can miss expectations and still skyrocket, simply because of how traders perceive the results. So it's not about what the actual news is, it's about how traders react to the news, right? It's about understanding the market behavior and the market sentiment rather than trying to predict what the news is going to happen next. That is why as a trader, you don't need to predict fundamentals, but you do need to respect their timing. Which is why I highly recommend you to always check the news calendar before you actually enter for a trade, right? Check for earnings, check for forecasts, check for Federal Reserve meetings or CPI releases. All of these high impact events can all trigger liquidity events that move the markets instantly. And if the market sentiment shifts overnight, it can cause your entire position to just reverse. So the key takeaway is this. Even if you're a technical trader, fundamentals, they still create the conditions for volatility. And volatility is what gives us opportunity. Now let's talk about the other side of the equation, which is technical analysis. This is what traders like me rely on every single day. Instead of analyzing the company's earning or growth and looking at balance sheet and financial statements, which is so boring that I almost always fall asleep, I focus on what price is doing right now, which is the structural, the trend, the volume, the liquidity behind every single move. And technical analysis is all about timing. It's all about knowing when to buy, when to sell, and how to manage your risk in between. So while investors use fundamentals to decide what stock to own, Traders, they use technicals to decide when to act, when to buy, when to sell, when to get out. Now, if you want to learn more about technical analysis, just go to my channel and you will see the hundreds of videos that I've created purely for technical analysis alone on how to mark up your supply and demand zones, how to identify and trade candlestick patterns, how to actually use trend lines, how to actually use supply and demand zones and spot liquidity. Everything is on my channel. With that said, you will see exactly how I use this approach, technical analysis, in the next section where I break down my trading strategy step by step. Now, before I walk you through my trading strategy, I want to show you a real example of how this system performed in the live markets. So this was a trade that I took on Nvidia using the exact same framework that I'm about to teach you. It's one of the setups that made me over $30,000 in a single position, all executed mechanically, with no guesswork, no emotional trading, no indicators, nothing. And once again, I'm not sharing this to flex. I'm showing it to prove that this works when you actually follow mechanical rules and you manage risk properly. Every single trade that I take follows the same structure, the same checklist, and the same mechanical process. Now, before I break down my full strategy, let's zoom out for a second. Every profitable trader, no matter what market or system they trade, they all have these four things in common. First, they have clear entry criteria, which means they know exactly what conditions need to be met before they enter a trade. No guessing, no fear of missing out. Second, they have predefined risks, which means they know exactly how much they're willing to lose before they click the buy or sell button. If the trade goes wrong, their system protects them automatically by incurring a small loss rather than a big loss. Thirdly, they have a repeatable review process. They journal their trades, they track their performance, and they constantly refine what works. And this is how you evolve from like a decent, mediocre trader to a consistent one. And finally, they follow a system that removes emotion. Because emotions, not market conditions, are what destroy 90% of traders. If your system forces you to follow your rules, you eliminate fear, greed, hope, euphoria, any one of these emotions. And this four criteria pretty much forms the foundation of my entire approach. The 30k Nvidia trade that I just showed you wasn't luck. It was the result of following this exact structure again and again with discipline for the past 7 years. Now let's go into the charts and I'm going to show you the entire trading strategy that I use to trade stocks, and I'm going to break it down step by step. Now, for my fellow stock traders out there, I got 3 tips for you. Number 1, focus on liquid large cap stocks. So pretty much stocks with more liquidity that is more commonly traded. Apple, Nvidia, Microsoft, Amazon, Meta, Tesla, all of these are large cap stocks that you can just stick to, right? Don't bother trying to trade penny stocks, especially if you're new. Number 2, avoid trades near earnings and news release, right? When a statement comes out, there's going to be a lot of volatility in the market, and that's something that you can't comprehend right now as a newbie trader. Number 3 is to define a watch list, right? So just add whatever currency pair, whatever stocks that you plan to trade onto the watch list itself and just focus on those stocks. Alright, with that said, let's dive straight into the strategy itself. Now, the first step is to always identify your bias, right? Is to always identify your trend direction by mapping up your market structure. So if you see price creating higher highs and higher lows, we know that price has just created like a bullish break of structure just like this, and we know that price is in the uptrend. If price is creating lower highs and lower lows, then we know that price is in the downtrend. I'm not going to go too deep into market structure in this lesson because I just want to show you the entire strategy at a high level. Bear in mind that all of this stuff that I'm going to share with you, right, the mapping out of market structure, identifying your supply and demand zones, I've done an individual video covering each one of these concepts in depth, right? So you can just find it on my YouTube channel. But anyways, first step, market structure. We have identified that price is actually in a bullish uptrend just like this. So we now know that price has shifted bearish in the short term just so that it could facilitate the pullback to the previous high low right here. So they can potentially create like a new high low right here to continue the bullish market structure. And we only want to trade in the direction of the entire higher time frame structure, which is why we will try to avoid counter trend trades. We will try to short over here, even though we know that price is pulling back, because it's much more higher probability to enter for longs over here and try to capitalize on the move to the upside, since we are trading in alignment with the higher time frame structure. Now, you also want to make sure that you mark up the swing low and the swing highs, right? So this will be my swing low that led to my break of structure, and then this will be my swing high that led to the pullback. So right now, like I said, our expectation is that the price is going to create a high low right here and continue bullish, right? So next question becomes, where exactly do we enter for the trade? So let's go now one step further to the 30-minute or the 50-minute time frame, all right? By the way, we are supposed to use the 1 hour or the 4 hour time frame to map out your structure, right? To identify your trend direction. Those are your higher time frames. You can use the 30 minutes or the 50-minute time frame to actually further map out your supply and demand zones, try to identify the price point which you want to enter for the trade itself. So the next step is on the lower time frame, which is the 50-minute or the 30-minute time frame, you want to spot for strong, clean breakout candles. Right, you basically want to spot these big bullish candles, BBC, or big bearish candles, BBC, right? So basically, just find the big juicy candles, right? So if I'm looking at this right here, I saw that this is the most obvious bullish candle, right? Big bullish candle. And the next question I want to ask myself is, did it break structure? Because you don't just want an ordinary candle, right? You want an ordinary big fat juicy candle that broke structure. That tells us that institutions entered at that price point, and that's the price point I'm most interested in. Okay, so you can see big bullish candlestick, broke structure, cool. This is where institutions entered for longs. And as retail traders, we want to follow their footprints, which is why the next time around price actually come back down to this price point here, which is the 222 level, we can potentially look for longs, all right? We can look for longs because this is where we know institutions are going to be entering for longs as well. And if price is like somewhere right around here, which means price has not come down to the 222 level, you don't want to do anything, all right? You want to wait very patiently for price to eventually pull back to the 222 level, and that is where we'll start getting involved, right? So here, do nothing, boom, price get to 222 level. This is where you start getting interested, right? So the third step is to wait for the pullback. The second step, get the momentum candle. Third step, wait for price to pull back to the momentum candle. And then this is where you can start planning your execution, planning your entry. So if I go down to, let's say, the 5-minute time frame, right, the lower time frame, ideally what I want to see over here is price losing momentum, which is why I want to see small candlestick bodies, right? I want to see this candlestick getting smaller and smaller, because the larger the candlestick, the more pressure, the more momentum there is, and the stronger the price will continue in that particular direction, which is why you can see there's a lot of momentum right here. But as price approach the 222 level, the bearish candlesticks start getting smaller and smaller, right? Which is a good sign for us, because it tells us that potentially the sellers are going away, and right now the buyers are coming into the market to take control of the market, and demand has overpowered supply. So this is where you can start looking for longs, right? So I would go one step further to actually mark up the zone that led to this impulsive move to the upside. Remember earlier on we mentioned that this is the momentum candle, right? This is the candlestick which tells us that there's a lot of institutional buying pressure, which also means that this area here, this $220 level here, this demand zone here, it's the price point where institutions are going to enter for longs again. So we can try to play the continuation move to the upside just like this, okay? Now, if you're a day trader, your lower time frame will be either the 15-minute time frame or the 5-minute. If you are a swing trader, then your lower time frame will be on the 1 hour or the 30-minute. Okay, so you basically want to jump down to your lower time frame only after price have came to the price point where we have previously saw the momentum candle. Alright, so if price over here, you do not drop down to the lower time frame. Alright, so if price still over here chopping, you don't even do anything. You just patiently wait. Wait until price get to your momentum candle price level, boom, drop down to your lower time frame. Right, so once again, for day traders, that's the 15-minute or the 5-minute. For swing traders, that's the 1 hour or the 15-minute. So since today I'm going to be day trading, I'm going to drop down to the 5-minute time frame. I saw prices came down to my momentum candle, is potentially mitigating this demand zone that we have over here. This is where I want to look for some form of confirmation that tell me that I should entering for longs, right? So to me, I have 3 types of confirmation. Number 1, a liquidity sweep, right? Which means I want to see price trigger some stop losses before the real move actually happen. Number 2, a shift in structure. I want to see the internal structure starts shifting bullish in order for me to know that the pullback is indeed over. And number 3 is a strong rejection candle, right? You want to see a big bullish candlestick just like this, right? An engulfing candle, or some form of pin bar candle, or some form of candlestick with like a long low wick just like this, because this indicate to me that the selling pressure is diminishing and the buying pressure is stepping to the market, and we're about to do this. All right, so you basically want to look for one of these 3 confirmations at this price point here. If you don't have any, then you should not enter for the trade whatsoever. All right, so at this price point, I'm asking myself, okay, do I see any one of these 3 confirmation? No, right? You can see nada, right? Because price literally just broke past that level here, and right now it start reversing. So this is where I'm getting interested, because what can happen is that price can sweep liquidity before the real move actually happens. So if price is not respecting this zone right here, it just tells us that there is not enough buying pressure at this zone. There is not enough liquidity, which means that price has to come down, maybe trigger the stop losses that we have below these lows right here. Previously from the buyers who previously entered for longs right here, right? Sweep some liquidity before the real move can actually happen, right? So if that happens, then guess what? That is one of my 3 confirmations, which is a liquidity sweep, right? So the minute I got a liquidity sweep at this momentum candle price point, you want to find a confirmation candle, which could be some form of reversal candles just like this, and then you can potentially look for longs right here. And then you can try to place a stop loss below the reversal candle and just target 3R just like this. Okay, so as you can see, later on price come up, smash a TP, as simple as that. All because we are very patient to wait for price to come back to the place where there was institutional buying pressure previously. And then we also wait very patiently for our entry confirmation to show up, which is in the form of a liquidity sweep. And then we make our entry on the pivot candle itself. Not on the bearish candlestick, but the next candle, right, which indicate the first sign of reversal. And then you just place a stop loss below that candle and then place your take profit at 3R, right? The reason why we just put 3R as our take profit is because we want to keep this strategy as mechanical as possible, right? I don't want to over confuse you guys with like complicated technical stops or technical take profit levels. So just stick to 3R, just stick to having like a mechanical execution. Now, before I show you the next example, I want to just slow down a little bit and just show you and break it down in another example. All right, so let's say you got out of this trade right here. If you got out of this trade, then what's the next step? The next step is that we are expecting price to shift bullish, right? The internal structure starts creating higher highs and higher lows, and eventually break out this high, and then we can potentially continue this bullish structure to the upside, right? But let's continue to see what price does next, all right? So price chop around, and then it went down even further. So when this actually happens, this tells us that the pullback is not over yet, right? There is still insufficient buying pressure to cause price to go all the way up here and take out this high here, which means that price is going to go deeper, right? The pullback is going to go deeper, maybe into this low right here, before we actually get the final move to the upside. So that gives us another opportunity to actually look for longs. So this is where I reevaluate the situation. I saw that, okay, price seems to blast right through this price point right here, so I can just delete this. Now, where is the next demand zone that led to break of structure? Where is the next momentum candle that led to the break of structure here? So if I go down to, let's say, the 5-minute time frame, I saw that this zone has already been broken, cool. But then the next area where there's a lot of demand is the origin point. It's the lowest point that led to the break of structure, right? It's gonna be this swing low right here. Because if you think about it fundamentally, we got price chop around here, comes down, goes up, pulls back, impulse move to the upside, pulls back, and then another impulse move to the upside, right? So you can see there's a lot of buying pressure here and here. But where did it all originate from? Well, it originated from this swing low right here. So this swing low could perhaps be the first time institutions actually step into the market. And then this is pretty much them just scaling in, all right? So once again, it's all about identifying your smart money footprints. Since this is the first time institutions actually step into the market, we know that price is going to be gravitating towards that area next. And another thing is what happened over here, right? Price goes up, pulls back, goes up, pulls back, goes up, pulls back, goes up, right? comes down, sweep all the available liquidity below those lows right here, right? Stop out all the retail trader stop losses here before the real move actually happens, right? So this is not just an ordinary swing low. It's what I deem as a protected low, which is pretty much a swing low that has swept liquidity, right? And that is an institutional level that I would definitely want to pay attention to. So the minute price actually mitigate that demand zone, right, which is indicated by the pivot candle, which is once again the protected low, right, the lowest point that led to the break of structure, I want to get involved, right? I want to get involved the minute price actually mitigate that zone. So the minute price actually mitigate that zone right here, straight away, without hesitation, I personally would just get involved right here, place my stop loss below the low, and just target 3R just like this. I wouldn't even look for a confirmation candle, to be honest with you. But if you want to go and one step even further, right, to wait for extra confirmation, like I said, you want to see liquidity sweep or shift in structure or some form of reversal candle, or rather like a strong rejection candle. And in this particular case, what do we have? We got price coming down here, pulls back, inducing, enticing retail traders to enter early. Later on, price comes down, sweep that low right here before pushing to the upside, right? So that itself is a valid liquidity sweep. So that's already one of our three confluences. Now, do we have a shift in structure? No, not yet, right? Because shift in structure only happens after price take out this high right here, which signal to us that this internal bearish structure is over when price actually finally take out the last lower high. Now, do we have a strong rejection candle? Yes, we do, right? Because if you look at this, what happens is that price goes down, create like this reversal candlestick right here, right? Like a little doji candlestick over here, which signal to us that a reversal is going to be happening soon. All right, so reversal candle, liquidity sweep, price mitigating the protected low, that swept liquidity, mitigating this demand zone. All the bells in the universe is ringing for you to actually enter for longs, right? So this is where you enter for longs right here at the rejection candle. Like I said, you can place your stop loss below the candlestick itself. Okay, if you are entering upon the entry candle, upon the pivot candle. But if you're entering upon the mitigation of the zone without waiting for entry confirmation, then your stop loss will be below the zone. Okay, so yeah, for simplicity's sake, I'm just going to show you guys one method, and that is just entry upon the reversal candle, right? The pivot candle, and you'll place your stop loss right below the candle itself, and you will target 3R as usual, just like this. And look at what price does next. Boom. Straight away, push to the upside. Look at this. Big bullish candlestick right here, guys. Like I said, this is the price point where institutions are getting longs, right? So you are pretty much just jumping in before the real move actually happens. Now, let's say you got out of this trade. Happy days. You buy your nice sneakers, right? You bring your family out to a nice dinner. What's next? Well, you continue grinding. You continue spotting for the next opportunity. And now, clear as day, we see this big bullish momentum candlestick, which means that price is going to be gravitating towards that price point again, right? So over here, price has finally come up and break structure, break through the last lower high, giving us a market shift, which signal to us that the pullback is over, okay? And we have saw that momentum candle. Now, we know that this demand zone right here, around like this, once again, 222 level, literally can't make this up, right? Same exact level as where we entered previously, is that institutional zone where smart money is going to be buying more, right? It's going to be entering for another bulk amount of buy orders, which is why the next step is to just wait very patiently for price to come down to this demand zone, right? So you continue waiting, right? Do nothing, continue waiting, right? Price doing this, whatever. We do not enter, we do not even go down to the lower time frame until price get down to this price point, okay? So eventually price chop around, right? Does it get down to there or not, or just continue flying up? Okay, cool. If you continue flying up, then yeah, it is what it is, right? There is no opportunity. Oh, it eventually does. Eventually does. Okay, cool. So eventually tap into our point of interest. Let's go back a little bit right here. So eventually price comes down to our institutional point of interest again, right? Institutional demand zone right here. Have it come down to the 222 level yet? Not really yet. Has it mitigated the demand zone yet? Not really. So we do nothing. Like I said, guys, no mitigation, nada, right? No entry, right? Eventually price comes down, boom, mitigating that point of interest, coming down to your beautiful 222 level, right? All right, so this is also, once again, the point of interest where there's a lot of buying momentum. So the next time price actually come down here, we are potentially looking for longs. Now, prices came down to this point of interest. What's next? You look for entry confirmation, right? So we want to see some form of clear reversal, just like this. You can see very clear reversal, big bullish engulfing candlestick, indicating there's a bunch of buying pressure coming into the market right now. Enter for longs, place your stop loss below the candle itself, right below, once again, the lowest point of like this reversal. And then you want to place your take profit at 3R just like this. Okay, now you can either place your stop loss below the lowest point of the reversal, which is this reversal candlestick right here, or you can place it below like this candlestick, this bullish engulfing candlestick as well. Doesn't really matter, right? Because price is not going to come down here ever again, right? Until like maybe a few weeks later. So let's see what price does. Boom, goes up, right? Continue chop around a little bit, and eventually, wait, this is live market condition. Oh wait, no, we did smash TP. No, we didn't even smash TP. Price just blast right through your TP. Look at that. Oh my days. So pretty much, you could have even placed your take profit all the way up here, and you have still made humongous outsized returns. That's that. That's the simple as strategy. Alright, so let's take a look at the next example, which is the bearish example on Apple stock. So first step, identify trend direction, right? So go back to the 1 hour time frame. I saw that price is pretty much coming down here. Broke structural. How do I know that? Because price is creating your lower highs and lower lows, right? So map out the most recent bearish break of structural right here. Map out my swing high, highest point that led to the break of structural, and also map out my swing low, which is the lowest point that starts the pullback. All right, so next, where is the momentum candle? Where is the money? All right, where's the money? So if you look at this, what do we have? The most obvious, right, big bearish candlestick is right here. One here, another one right here. So a lot of selling pressure at this price point here. So you also want to be marking up all the supply zones, right, that created like this big bearish candlestick. So this is the highest point right here. And then there is also this big bearish candlestick that is being created right here by this little supply zone right here. Okay, so these are the two price points where we know that there's a lot of institutional selling pressure, right? Which is why right now we're going to be doing nothing until price reaches that area. And by the way, I've also turned on like the volume indicator below so you can really see the selling pressure, right? You can see the higher the bar graph, the more orders there is in the market, right? The more volume there is in the market. So you can see there's a huge amount of selling pressure at this price point here. There's also a huge amount of selling pressure at this price point here as well, right? So we know once again that price is going to be gravitating towards those areas, which is also why we do nothing until price reaches that area. All right, so right here, just be patient, do nothing, boom, price comes down to the first point of interest. All right, the minute price comes down to the first point of interest, I want to look for some form of entry confirmation, right? Because right now, price can either reverse at this near supply zone, or it can go back up even further to this deeper supply zone and then reverse. But I don't really know which one's going to happen next. I don't really know which point of interest is price going to respect because I don't have a bloody crystal ball, all right? I can't predict where the market is going to reverse. But what I can do is to wait for entry confirmation that put the odds in my side, right? So as a result, once price mitigate a point of interest, I'm waiting for my entry confirmation, right? Is there any sort of reversal candlestick? No, you can see right here. Price reaches this point of interest, blast right through it. Okay, so the minute prices blast right through it, then you know that this is not the point of interest that you want to enter on. And price has entered into this extreme point of interest, right? So this is where you might want to get involved. Let me just refine it to the pivot candle right here. Okay, once again, this is the highest point that led to this break of structure. This is also the swing high that swept available liquidity on the left-hand side as well, right? So this is also a protected high, right? So protected high, extreme supply zone, the last line of defense that price has to hold in order for price to remain bearish. So this is where I'm looking for my entry confirmation, right? Let me go down to the 15-minute time frame. So once again, ask yourself, do you have any one of the three confirmation? Do I have a liquidity sweep right here? Yes, I do, right? Because price is technically sweeping the available liquidity above all of these highs right here. All right, so this is my liquidity sweep. Do I have a shift in structure? Not yet, right? Because price will only start shifting structure if price take out this low right here. Do I have a strong rejection candle? This is not very convincing, to be honest with you, right? But it is still indeed a bearish candlestick, right? There is still some form of selling pressure. Now, let's just continue and wait because I want like more confirmation that tell me that price is indeed gonna collapse. Right, so let's wait. Okay, nothing. All right, you can see selling pressure starting to come into the market, and observe the candlesticks. Observe the bullish candlestick getting smaller and smaller because this tells us that the buying pressure is fading away. All right, so just wait and wait and wait. Boom, look at this. Clear as day, we are starting to get that arc. We are starting to get that V-shaped reaction. Bearish engulfing candlestick, mitigating the supply zone, mitigating the protected high right there. So this is where I'm more than happy to actually get involved in a sell right now and place my stop loss once again above the bearish engulfing candlestick or above the highest point of the reversal right here, and just target 3R, which is just like this. Okay, just book it to 3R just like this, and let's see what happens next. Price goes down, boom, absolutely collapse. It blew right past our TP because there is so much selling pressure at this supply zone, right? Once again, that's what happens when you're able to sweep all the available liquidity, right? That gave the fuel the market needed to just absolute collapse. You can see it literally broke all the way down to this 226 level. Not to the 222 level, right? But I'm pretty sure it's going to drop down to 222 level soon, just like what we have seen on Amazon. Anyways, that's pretty much how you do it, right? Very simple mechanical framework. You can see there is no point in time where I second guess my entry, where I think about whether I'm doing the right thing or not, because I have a set of clear rules which I follow. I know exactly what I'm looking for when I go onto the markets, and I don't do anything until all of those criteria get met, which means that a lot of times profitable trading is boring, it's repetitive, and it involves a lot of waiting for the A+ setup to actually happen. Okay, so now that you've seen how I apply it live, let me explain why this strategy actually works. Because once you understand this part, it will actually make a lot of sense to you on why I don't use like 100 different indicators or fancy charting tools. Now, first of all, this entire approach is based on momentum, volume, and liquidity, not indicators. Indicators are simply lagging representations of what price and volume already tell you, which is why I freaking hate indicators. Now, secondly, when institutions enter, they leave a footprint in volume and structure, and that's exactly what we are tracking. We are pretty much just following their footprints. And that is exactly why this strategy works, because institutions, they create the move, and we follow after the confirmation. Once again, we're not trying to predict the top or bottom like what beginners do. Instead, we wait for the big money to commit, right, to show us where they have entered, and then we simply align ourselves with that direction. And that's what gives us clean and high probability setups. Thirdly, it works across all the different time frames. Whether you are trading on the 15-minute time frame, or the 1-hour time frame, or the daily time frame, whether you are a scalper, a swing trader, or intraday trader, the framework doesn't change. Only your execution speed does. Only the set of time frames that you use does. And that's exactly what makes this strategy robust and scalable. You can use the exact same logic whether you are day trading Apple, or swing trading Amazon, or position trading Microsoft. And last but not least, it's repeatable, it's simple, and it's data driven. Like I said, there is no emotion, there is no guessing, there is no signals, there is no indicator. You're simply trading patterns of human behavior that repeat over and over again, which involve liquidity, momentum, volume, and structure. Like I said, guys, you really do not need any fancy indicators, because when big institutional funds, they enter the market, volume and price, they tell the entire story. Your job as a trader is not to predict where price is going to go. It's to identify the footprints and align yourself so that you can trade with them rather than against them. And once you master that, trading becomes boring, mechanical, and extremely profitable. Now, people always ask me, Brad, should I trade Forex, crypto, or stocks? Should I trade Apple, Nvidia, or Tesla? And my answer is always the same. Mastery beats diversification. Do not try to be a jack of all trades, because you will end up becoming a master of none. In trading, the goal isn't to understand every single market to a T, but rather is to go an inch wide and a mile deep in one. Which is why you're much better off studying one asset class until you can read it like a language. Study one trading style and one stock until you can actually really trade it as though it's second nature. And most importantly, you want to be extremely patient because the real money is made in the long game. I've been trading for 7 years. And in the last 1 year, that's where I made the most amount of money in my entire trading career. And that's really how you gain a competitive advantage that lasts. So if you're serious about trading, here's your roadmap. Firstly, learn the foundations. Learn technical analysis, trading psychology, risk management, fundamental analysis, and do not skip the basics, right? Because the foundation is what will allow you to build the house on. And if the foundation is weak, it's built on a sand, the entire house is going to collapse, right, when a tornado comes. Secondly, build your trading plan. Like I said, you want to structure your entire trading system around your lifestyle, around your personality, around your risk tolerance. Ultimately, find your own unique edge and use a mechanical plan that removes guesswork and emotions from the equation. And thirdly, you want to backtest and journal, right? Because this is where you want to be really focused on gathering as much data as humanly possible about your strategy so that you can actually build undeniable conviction and confidence. And finally, when you are ready, you want to scale gradually, right? You want to be the tortoise that is focused on being slow and steady rather than the hare that goes extremely fast but start getting complacent and start losing everything, right? So focus on consistency rather than trying to get rich as fast as possible while putting in the least amount of effort possible. Now, if you want me to walk you through all of this step by step, I made a 10-hour full trading course. Yes, you heard that right. It's 10-hour long. And it's completely free. It breaks down everything from technical analysis to trading psychology to execution to managing a risk to scaling to 7 figures. Everything is in there. And you can check it out over here, right? Just go and click on it. It's free and it's extremely valuable and it works whether you trade stocks, crypto, futures, or whatever little niche you like to gamble in. All right, so check that out. And as always, we are just one trade away. Mwah.